profit. The markets continuing their little seesaw, but it's a seesaw within a tight range in a sense, at least for the last hour and a half. 7,041 on the Nifty right now, 23,188 on the Sensex, in the green for both of those benchmark indices. Pleased to welcome Rajeev Dimri, leader Indirect Tax, BMR and Associates. Also joining us, Rajeev Talwar, Chief Executive Officer at DLF, and Sunil Singhania, CIO, Equity Investments, Reliance Mutual Fund. Gentlemen, good afternoon. Thank you for joining us. I'm going to come straight to Mr. Dimri. We haven't really focused very much so far on the indirect taxes and that piece of the puzzle. It seems like there's a increasing reliance on indirect tax collections to finance, this government's budget. Mr. Dimri, what did you make of the proposals?
Well, a lot of areas have been touched. This 9-point area, for the first time, the direct and indirect tax proposals were not segregated. It was centered around those 9 points, so that's a better way to look at it. But the details are yet to be seen. Net, there is 20,000 crores more to be collected from indirect taxes. The 15-16 was anyway an enhanced collection of indirect taxes. So we're talking about more than what was already collected in the previous year. So a lot of money is coming out of indirect taxes at the macro level. Yes, some sound bites on Make in India, defense, Digital India, but a lot more details need to be seen. Some rational. Yeah,
sorry, did you like what you heard about dispute resolution?
Well, two parts of dispute resolution. One is the expansion of the, SESTAT benches. 11 new benches will certainly go a long way in a faster disposal rate of the taxes, and that surely will unclog the system, and I should see some, faster recovery. On the voluntary dispute settlement, we need to see the details. The general data of the government is they collect finally 15 rupees out of every 100 of dispute that they raise. If that's not going to be attractive for the taxpayers, why would they withdraw their appeals? So that's something that I'm going to go back and look at a lot more closely. But based on the headlines which says pay all the taxes and interest and we will not charge you penalty, just assessing that doesn't sound very exciting to me, but I would reserve my final comments on seeing what the details are, but something very interesting.
And are you surprised by the lack of, well, the GST roadmap? I know we've spent, a lot of airtime discussing GST, but in the budget speech, would you have liked to see more?
Yes, I would have liked to see more, but I think when more was said in the past, that really didn't matter. So I'm not particularly disappointed with that alone. There are two differing signals coming out. One, there is a talk and a proposal to align the SENVAT credit rules of excise and service tax, which is a large step towards GST. On the other hand, many new cesses have been imposed this year, and the finance minister himself had indicated that we need to get rid of all the cesses to have a unified GST. So on one hand, there is a specific step which is getting us closer to the GST, which is alignment of the SENVAT credit rules. On the other hand, many new cesses seems going a little bit away. So there's
not
a bit
of a contradiction coming there. Mr. Dimri, we're going to leave it at that. Thank you very much for your comprehensive review of the indirect taxes and the proposals in this budget. We have Rajeev Talwar and Sunil Singhania with us. Prashant?
Let's get some comments in. Mr. Talwar, first to you, sir. For the real estate sector, there have been some...
real estate sector, I think, has been covered well.
Sorry, go on.
Going by the number of advertisements in your commercial break, I would say that the budget has been received well. There were very large number of advertisements. But coming specifically to the real estate sector, as we all know, 90% of the demand exists in the affordable housing sector. I think that's been given an infrastructure status indirectly by making profits 100% tax exempt and to be replowed into the sector. So that's very good news for employment. That's very good news for community service providers, right from 30 square meters to 60 square meters, which should mean a good flat on the periphery of Bombay, Mumbai, and in satellite cities for as much as up to 750 square feet. So that's really very good news, and with no service tax being added to it, even if MAT kicks in, that's a relief which goes a long way, 33% and plus 15%. So that's a very good relief for affordable housing. I think the Prime Minister's dream to provide a roof over every family and household should be getting fulfilled by a huge spurt in this segment of construction and real estate and housing. The second proposal that one found very, very good was to raise the exemption limit from 2 lakhs to 2.5 lakhs on housing loans up to 35 lakhs and houses and apartments costing up to 50 lakhs. I think for the younger generation who are getting into steady jobs, that is a very, very good opportunity for them to invest into their own homes, especially I think for women. That women who are single and working make an initial investment and then go on to live in that house of their own. This should mean not only financial security, but for a large number of parents, very great emotional security about their daughters. Even for young men, it's an equally good investment opportunity. And I think these two steps should add a lot to a spurt in construction activity and thereby giving a multiplier effect to all those who work in this sector and those who manufacture in India for this sector. The third portion, which is linked to it, was the raising of exemption on rental from 25,000 to 60,000. I think those people who provide housing of single rooms or two-room housing on rental basis to young people or to people who can afford only that much, yes, they should come as a boost for that housing too. And therefore, overall, in the provision of housing owned or rented to those sections of society who are looking out for cheaper and affordable housing, it should mean a great opportunity right now in the budget for the next few years. The last portion which I would like to cover is the DDT provision for REITs and infrastructure investment trusts. As we understand at the moment, one will have to look at the finer details, but it possibly means exemption. I think that would mean, along with the earlier proposals passed by the government in the FDI policy, it should mean a very great inflow of funds into India, which the government was hoping for in billions of dollars. This would be an opportunity which the foreign investment and investors were looking out for, that yes, their returns should be greater, and since they would carry no debt on their books, which would actually allow some room for Indian companies to go into REITs, for foreigners and for foreign institutional investors to come into India, this would mean a good new opportunity which they've been waiting for. So in all, I think for housing, construction and real estate, an excellent budget.
Mr. Talwar, very comprehensive. Thanks very much. And I think now we have to wait for the RBI to move. I guess we'll do that.
Yes.
Thank you.
In fact, that is the next thing, yes, that to cover that 10% of the housing segment, yes, which is middle class and upper middle class housing, I think for that, right, one will not only have to wait for RBI, but along with the capitalization of banks, I'm sure there will be room for banks to lower interest rates. If that happens for the first 2 years below the base rates, I think then we've got the entire sector going up demand wise, and therefore the excess supply which exists in that segment of housing should get absorbed much faster than the expected 3 to 4 years.
All right, Mr. Talwar, thank you very much, sir. Good speaking with you. Sunil Singhania is with us, needs no introduction, top boss at Reliance Capital. Sunil, thanks very much. Afternoon. How do you rate the budget?
So I think, a lot has been already said, so there is very little incremental I can share with you. But the only good thing is that this is a policy statement. It is behind us. There has been no disruption in terms of the way we do business, the way the investments have taken place. And I think the fact that a lot of market participants were expecting some tinkering with the capital gains, and that has not happened, I think that should be the biggest positive from a capital market perspective. Obviously, the fact that the 3.5% fiscal deficit target has been retained despite additional both planned and unplanned expenses, I think that should be a key positive. There have been some segments, obviously, where there has been some enhanced tax, specifically so-called the HNI or the rich category, whether it's a dividend over a particular amount or or some tinkering with excise on garments above a particular amount, as well as ATF, fuel, and even on motor cars. Other than that, I think it's been a pretty good budget given the circumstances we are in, and the fact that we have maintained the fiscal deficit at 3.5%, as I mentioned earlier, should give us hope that some kind of rate cuts can be expected as we move forward. So I think all in all, a pretty decent budget.
This more and more things are getting clear as they do every budget. A few hours down the line, many more things start appearing as well. So this oil bit, I mean, cess has been changed from 4,500 rupees a ton to 20% ad valorem. I think much higher than what was expected.
No, I think the current cess is 9,000. The expectation was that the cess would be reduced to 4,500. So in that sense, the cess has been reduced, but it is lower than what people expected. But I think it's okay. You'll have some sectors which will be positively impacted here and there, and some which would be negatively impacted. But I think we have seen over the past 4 or 5 years that the budgetary announcements and the tinkering as far as the tax rates are concerned are sort of taken the stride by the respective companies and sectors, and we are back in business as normal in the next few weeks. So we should not be unduly worried about that.
No, the cess payable to the government by upstream oil marketing companies was 4,500 rupees a ton. That is now 20%. That is what I'm reading from the document, which is now uploaded. So this is, maybe you're talking about something else. I think there was another expectation as well, but this is the cess to the government from companies. I think oil market,
Our understanding is that it was 9,000 rupees, and which has been brought now to 20% ad valorem.
Okay, fair enough. Tobacco, Sunil, the 10%, 10.3 odd percent is the average hike. Better than expected?
See, again, as I mentioned, Prashant, 1 or 2% here and there should not lead to any major sort of case for either investment or disinvestment, in respective stocks and sectors. So yes, there are a few sectors which obviously pre-budget always have some negative expectations. Cigarette is one of them. And, the expectation was that there would be a 12 to 15% hike in excise on cigarettes. Instead, it's come to more closer to 10%. So we have seen some short covering maybe, from day traders there. But I don't think that 1 or 2% lower is going to make a person, take a fresh view. So I think it's status quo as usual. There should not be anything too much read into a small, surprise, both on the positives and the negatives as far as sectors are concerned.
Sunil, it's quite telling. You said in a way the biggest positive is what has not happened in the budget, right? Tinkering with capital gains, etc. So in a way, and we've heard this from other corporates as well. Now there isn't very much. They didn't have very much room to do things. They stuck to the target. So this is what you essentially get. But in terms of enthusiasm or making any significant change, I mean, this budget doesn't do that, right?
So yes, the leaving the capital gains as it is has been sort of a positive in the sense that there was a built-up of a case for imposition of long-term capital gains or increasing the tenure of your investment, which would qualify as long-term. That has not happened, and obviously when you expect something negative and the negative does not come in, it is taken as a positive. On the overall policy document, I think the message is very clear. The country has to focus on development. The country has to focus on agriculture, and the country also has to focus on infrastructure. So the outlay for road and rail has been increased quite dramatically. Without increasing the fiscal deficit, the finance minister has ensured that the poor are given a little bit of a benefit at the expense of taxing a little bit more as far as the so-called luxury items are concerned. So I think in the direction I think the budget has met our expectations. But increasingly over the last 3-4 years, if you see, the budget is more now a policy statement rather than a tinkering of taxes too much, because our tax regime is more or less settled. This budget obviously is trying to get the message that we are giving you one last opportunity to come clean by way of so-called VDIS scheme. Again, the message is very clear that henceforth the tax compliance would be taken very seriously. So I think in terms of the direction and the message, the budget comes out very, very clear.
Sunil, thanks very much. Great speaking with you. Appreciate you joining in, as always, with that perspective. Mr. Ramesh Damani is with us as well, market veteran, member BSC. Mr. Damani, thanks very much. Afternoon. Prashant here. Your take, sir.
Hi, Prashant. Thank you. Prashant, I think the market dodged a bullet. The market for the last few weeks was overwhelmed with the fear of long-term capital gains being introduced for some reason. It was pervasive. The fact that it didn't come, as your earlier guest also suggested, was treated as a positive. I think they've not tried to usually do the tax and spend regime. They've been stable on service tax. They've been stable on the corporate tax. The only thing is the dividend distribution tax, which doesn't make much sense to me. But if the finance minister to choose between the long-term capital gains and the dividend distribution tax, I think he chose wisely. So he dodged a bullet. I think it's now up to the RBI. Hopefully they will start reducing rates in the next few weeks, and then we'll go back to global flows.
The dividend distribution tax over 10 lakhs, I mean, a dividend income over 10 lakhs, I mean, how you're saying you don't approve of entirely, but if it's a toss-up, then this is, I guess, this is reasonable. But will it make a large difference? I mean, I guess to promoters, to HNIs?
It will, but you can't tax something 3 times, basically the same source of income. You tax 30% corporate profit, 20% dividend distribution tax, and now 10%. So it's almost like 60% on an aggregate basis. It doesn't seem fair, but I think given the hard choices of how you deduct it, where you capture it, or doing long-term capital gains, I think that was the wiser choice. But they probably need to come out with a more streamlined way to do it. I think 60% tax for the same source of income is not necessarily the wisest thing to do.
Mr. Damani, for markets, I mean, what does it mean? Does it, we've been on a southward journey for a while. Do we resume that journey? Focus tomorrow morning again gets back to China, etc.?
Well, here's my narrative that I've been trying to tell my friends and clients for whatever it's worth. Market needs a bull market, or any market needs a narrative of where do you think it's going, a story of where do you think it's going. My story is very simple. One of these days, the market's been in a funk. Global markets have been in a funk. One of these days when the markets will wake up, they will see that the S&P 500 on Wall Street yields 3.1%. The dividend yield on S&P 500 is 3.1%. In a world of negative interest rates, stocks are yielding 3.1%. In a world of very poor growth, 1% growth, Dalal Street is predicting that the economy will grow at 7.5%. So at some point, the market wakes out of funk and say, oh, these are greener pastures, these are higher mountains, let's move. If S&P is 3.1%, that's a floor on the Dow. If Dalal Street is 7.1%, value hunting should emerge from some point. That will now depend on what the foreign selling comes to. But I think at some point, some differences of opinion will emerge. And also, Prashant, if you notice, the market has made a bottom 3 times at 69.50 level. A few weeks ago, last Wednesday, Thursday, and again today. From that 6,900, 7,000 levels, strong resistance, bouncing back. Let's hope now that's an intermediate bottom for the market.
Mr. Damani, thank you very much. It's a pleasure speaking with you. Appreciate your time here very much. Thank you. You know, the big stock which is selling off is ONGC. And we highlighted this about 20 minutes back. The cess which companies pay to the government was 4,500 rupees a ton. That has now been changed to an ad valorem rate of 20%. Expected number was a rate of about, I think, 10% or so, actually 7 to 10%. What the 20% rate does is it puts the tax outgo for companies only marginally lesser than the earlier regime of a fixed rate. So that's the point. I mean, I think that's a disappointment here. So I think ONGC, K and Oil India, all of these stocks are actually selling off. But ONGC is, of course, selling off the most right now. ITC is, let's just put the name up. It was up about 2% wild swings. I mean, the day low on ITC was about 268. It's at about 295 now. So huge moves. But, I mean, you know, the Nifty had seen very, very large moves as well today. 17 stocks are higher, and the rest of the names on the Nifty 50 at least are down at this point. Maruti, 3254. Put up Maruti. I mean, that's a 4.5% cut. It's 10 rupees off the lows, but it's a large cut. The high, of course, on Maruti was some 4,800 rupees. So it's a long way off. And the budget today hasn't helped. Infosys is down 3. BHEL at about 92. Z, Wipro, Axis Bank, Cipla, Sun, etc. are some of the other stocks. We are taking a very quick break here. We are coming back in 2 minutes. The last 30 minutes of trade coming up when we return. Shankar Sharma is going to be with us. He's Vice Chairman, First Global. Pankaj Razdan, CEO, Birla Sun Life Insurance, also joins in. We're back with him.